So in this lesson, we're going to be comparing variable versus absorption costing side by side. And the main key objectives of this lesson is to uncover why profit differs under absorption costing versus variable costing. Secondly, the role of opening inventory and closing inventory on the profit differences. Fourthly, how fixed manufacturing overheads moves through inventory. And lastly, how to reconcile absorption profit and variable costing profit. So those are the key main objectives. So technically, we're trying to explain why do the two systems differ, especially from a profit perspective, and how we can really reconcile the two. So just a quick recap. In the previous lesson, we prepared income statements using both absorption costing and then variable costing. So both methods, they used the same sales, same cost, same production information. However, the final profit was different. So if you remember, under absorption costing, we got a profit figure of 74,000. However, under variable costing, we got a profit figure of 54,000. So we basically going to try to unpack what causes the difference between the two. And we've already emphasized this over and over and over again, that the main reason of this profit difference is how we treated fixed manufacturing overheads in each of the costing systems. So the main difference under absorption costing and variable costing is that fixed manufacturing overheads under absorption costing are included in product cost. This means that they are stored in inventory because they form part of product cost and they basically stored in inventory. However, under variable cost, fixed manufacturing overheads are treated as a period cost, meaning that they are expensed immediately in the period in which they incurred. Under absorption costing, they stored in inventory and only expensed once inventory is sold. And remember, once inventory is sold, we expense it through cost of goods sold or cost of sale expense. So that's the only time we expense them under absorption costing, when these products are sold, because the fixed manufacturing overheads are sitting in product cost or in inventory. And for them to be expensed, we need to sell the goods first. However, under variable costing, we do not include fixed manufacturing overheads in product cost. Instead, we expense them immediately when they are incurred. So the key question is, where is the fixed manufacturing overheads sitting? So whenever we're trying to understand the key differences in profits of the two systems, we really need to understand where the fixed manufacturing overheads are sitting. So the real issue is inventory here. The profit difference is caused by the fixed manufacturing overheads in inventory, and specifically opening inventory and closing inventory, right? So the two balances affect profit differently. So I'm just going to give you a snapshot, and then we're going to go deeper in what I mean by each. So opening inventory can reduce absorption costing, and closing inventory can increase absorption profit, right? Opening inventory can reduce absorption costing profit. Closing inventory can increase absorption costing profit. And I'm going to dive a bit deeper on what I mean by that in the next coming slides. However, this is the foundation of the reconciliation, as basically understanding what are the fixed manufacturing overheads sitting in opening inventory and closing inventory and how they affect each of the profits. And let's dive a bit deeper on each of the points. So important point to note is, when we talk about fixed manufacturing overheads sitting in inventory in this lesson, we are mainly interested in the fixed manufacturing overheads that are included in inventory under absorption costing, because remember, under variable costing, inventory does not include fixed manufacturing overheads. Under variable costing, fixed manufacturing overheads are expensed immediately and they never form part of product cost or inventory. So the reconciliation focuses on the fixed overhead portion that are sitting in inventory. And like I said, specifically, the ones that are sitting in opening and closing inventory. So that's what we're interested in, the fixed manufacturing overheads that are sitting in opening and closing inventory. So let's start by explaining what is opening inventory for those who might not understand what I mean by opening inventory. So in simple terms, opening inventory is inventory brought forward from the previous periods. So these are goods that were produced before in the previous period but not sold by the end of the previous period, meaning that they're going to sit in opening inventory for this current financial year. And under absorption costing, remember this opening inventory includes fixed manufacturing overheads from the previous period, because under absorption costing, we allocate fixed manufacturing overheads to the products. However, under variable costing, opening inventory does not, it excludes fixed manufacturing overheads, because remember, we expense them fully in the period that we incur them, which is last year. So under opening inventory, we do not have any fixed manufacturing overhead sitting there. And we would have seen from the example that we did that we had a product cost of 250 under variable cost and a product cost of 350 under absorption cost. This one included fixed manufacturing overheads. This one did not excluded fixed manufacturing overheads, which is why we had a higher product cost under absorption costing and a lower product cost under variable costing. So that's like the key difference, that the opening inventory under absorption costing includes fixed manufacturing overheads from the previous period. Under variable costing, it excludes fixed manufacturing overheads from the previous periods. So how does opening inventory affect profit? So when opening inventory is sold in the current period, remember the inventory that's sitting in opening inventory was not sold last year. However, it's going to be sold in this current period. And when it's sold, it becomes part of cost of goods sold or the cost of sale expense. Remember, if we sell the units this year, we're going to calculate it under cost of sale expense because we sold them this year, and they going to form part of the sales for this year and also the cost of goods sold for this year, right? So under absorption costing, the fixed manufacturing overheads that are inside the opening inventory are then released into cost of sale expense in the current year. So remember, I said under absorption costing that product cost was 350, meaning that in the current year, when we sell this opening inventory, that fixed manufacturing overhead that was sitting in this product cost is going to be expensed under cost of sale expense in the current financial year. So this increases the cost of goods sold expense because we're expensing last year's fixed manufacturing overheads this year. And the higher cost of goods sold or the higher cost of sales expense means that we're going to see lower profit under absorption costing. So basically, opening inventory reduces absorption costing profit compared to variable costing profit, because under absorption costing, we're going to expense 350. However, under variable costing, we're only going to expense 250, which is the product cost that excludes fixed manufacturing overheads, because remember, product cost under variable cost does not include fixed manufacturing overheads. So under absorption costing, if we expensing 350, however, under variable costing, we're only expensing 250, it means that absorption costing profit will be lower, right? Absorption costing profit will be lower. Why? Because we're expensing a higher amount than under variable costing profit, right? So opening inventory reduces absorption costing profit compared to variable costing. Why? Because the fixed manufacturing overheads that were stored in inventory under absorption costing are going to be expensed this year in the current period when we sell these units. So here's an example just to consolidate your understanding of this. Let's assume that Brightwood has opening inventory of 100 desks, and each desk include fixed manufacturing overheads per unit of 100 Rand per desk. So this was our absorption rate for last year that we used to allocate fixed manufacturing overheads to product. So the total fixed manufacturing overheads that are sitting in inventory are your 100 desk times the 100 Rand per desk. It's 10,000 Rand. So this 10,000 Rand will be included in the absorption costing cost of goods expense or cost of sale, when those desks are sold in the current year, meaning that absorption costing profit will be 10,000 lower than variable costing profit. Why? Because this 10,000 fixed manufacturing overheads that were sitting in opening inventory under absorption costing are going to be expensed this year under cost of goods sold. So opening inventory impact. So under absorption costing, the 10,000 fixed manufacturing overhead from opening inventory is expensed through cost of goods sold. However, under variable costing, remember, the fixed overhead is not in inventory. It was expensed in full last year. Because remember, the fixed manufacturing overheads under absorption costing are never part of product cost. However, they are expensed in full in the period in which they are incurred. However, under absorption costing, we stored 10,000 worth of fixed manufacturing overheads to our inventory, and then that inventory is opening stock now. And this year when we sell that stock, it's going to form part of the cost of goods sold expense. So absorption profit in the current year is lower by 10,000 because of the opening inventory, the 10,000 fixed manufacturing overheads that were sitting in opening inventory. I hope that clarifies why opening inventory or the fixed manufacturing overheads sitting in opening inventory are going to cause absorption profit to be lower. Now let's move on to closing inventory. So closing inventory is inventory that is left unsold at the end of the current period. So these are goods that were produced but not yet sold at the end of the current period. Under absorption costing, closing inventory includes fixed manufacturing overheads. Remember, under absorption costing, we calculated a predetermined overhead rate or an absorption rate, and then we included fixed manufacturing overheads on the product cost. Hence, they're going to sit under closing inventory. Your fixed manufacturing overheads are going to sit under closing inventory, depending on how much was allocated to each unit. So under variable costing, closing inventory excludes fixed manufacturing overheads, as all fixed manufacturing overheads were expensed immediately in the current period. So under variable costing, all fixed manufacturing overheads incurred are expensed in the current period, and none is stored in closing inventory. So how does closing inventory affect profit? Under absorption costing, some fixed manufacturing overhead are kept in closing inventory. This means that it is not expensed yet, right? It is not expensed yet because they're sitting in closing inventory. They're only going to be expensed when this inventory is sold, which is next year under absorption costing. So these fixed manufacturing overheads that are sitting in closing inventory are only going to be expensed next year when these goods are sold through cost of sale. So this means that there's lower expenses under absorption costing because some of these fixed manufacturing overheads are deferred to next year. Meaning that under absorption costing, we're going to see a higher profit because some of these fixed manufacturing overheads are deferred to next year. They're sitting in closing inventory and only going to be expensed next year when this inventory is sold. So closing inventory increases absorption costing profit compared to variable costing profit. Remember, under variable costing, all these fixed manufacturing overheads that we incurred are expensed immediately in this current year. However, under absorption costing, some of these fixed manufacturing overheads are allocated to closing inventory and are deferred, only going to be expensed next year when we sell these products. So absorption costing is delaying the expense of fixed manufacturing overheads that are sitting in closing inventory, right? So absorption costing profit will be higher because some of the expense, which is fixed manufacturing overheads sitting in closing inventory, are deferred to next year. Another example to understand this. So from our previous example, we saw that Brightwood produced 1,000 desks and they only sold 800 desks. So our closing inventory is 200 desks. And our fixed manufacturing overheads per desk was 100 rand. So this was our absorption rate or predetermined overhead rate. And the fixed manufacturing overheads in closing inventory, in total, it's your 200 desks times 100 rand per desk, which is the fixed manufacturing overheads per desk, you get 20,000 rands. So 20,000 rands worth of fixed manufacturing overheads are sitting in closing inventory. And remember, under absorption costing, we basically delaying expensing this fixed manufacturing overheads. So deferred expense only expensed next year when goods are sold under cost of sale expense. So the impact is basically under absorption costing, the 20,000 fixed manufacturing overheads stays in closing inventory and is not expensed yet in the current year. They're only going to be expensed next year when these goods are sold. However, under variable costing, the full fixed manufacturing overheads are expensed immediately. So absorption profit in the current year will be higher by 20,000 because closing inventory delayed the expense of some of the fixed manufacturing overheads. However, under variable costing, we expensed them in full, meaning that the profit under variable costing will be low. However, absorption costing profit will be higher. Okay, so the full reconciliation logic, right? So opening inventory and closing inventory, they work in opposite directions. Opening inventory brings fixed overheads into cost of goods sold. This decreases absorption costing. So under absorption costing, opening inventory brings fixed overheads into cost of goods sold. So those fixed overheads that were delayed from last year, now they're sitting in opening inventory under absorption costing. They going to be expensed in the current year and they're going to decrease absorption profit. However, closing inventory works in the opposite direction. Under absorption costing, closing inventory keeps fixed overheads out of cost of goods sold. Remember, some of the fixed overheads are sitting in closing inventory and they are deferred to the next year when these goods will be sold and then expensed. So this increases absorption profit in the current year because some of the fixed manufacturing overheads incurred are deferred through closing inventory. So here's the full reconciliation formula that I want you to note down, memorize, and remember. So the reconciliation can be shown as this. So to move from variable costing profit to absorption costing, you always subtract the fixed manufacturing overhead sitting in opening inventory, and then you add the fixed manufacturing overhead sitting in closing inventory. So this is the key formula for this lesson. And just to note, always start, if you want to memorize, always start with variable costing profit, subtract fixed overheads in opening inventory, add fixed manufacturing overheads in closing inventory, and that will give you absorption profit, right? So what we're technically saying here is if we want to move from variable costing profit, we need to subtract the fixed manufacturing overhead sitting in opening inventory, because under your absorption costing, there would have been an expense in the current year, decreasing this profit. Hence why we need to, when we're moving from this one to this one, we need to subtract opening inventory. However, closing inventory works in the opposite direction. Remember, we said it's causing absorption profit to be higher. And if we're moving from this to this, we need to add it because an expense was deferred here, right? An expense was deferred to the next year, causing the profit to be higher. So if you want to memorize the formula, just remember that you start with variable costing profit and then you end with absorption costing profit. So variable costing profit minus fixed manufacturing in opening inventory plus fixed manufacturing overheads in closing inventory. So you might be asking yourself, Blessing, why did you put 0 here? So if we're using the information that we were given for this specific example, we were not told of any opening inventory. Hence why we're saying there was no opening inventory, meaning that there was no fixed manufacturing overheads sitting in opening inventory. However, we know that we were told that there was a closing inventory of 200 units. So there was closing inventory of 200 units. And the fixed manufacturing overheads that were sitting in these 200 units under absorption costing were 100 Rand per unit. Remember the absorption rate that we calculated here. We said each unit is going to be allocated with 100 Rand of fixed manufacturing overheads. So when we calculated the fixed manufacturing overheads sitting in closing inventory, we're just going to say 100 Rand times the 200 units. And that gives you the fixed manufacturing overhead sitting in closing inventory. So this formula always stays the same. To reconcile from variable costing profit to absorption costing, we start with variable costing profit, we subtract fixed manufacturing overheads in opening inventory, we add fixed manufacturing overheads in closing inventory, and we should get your absorption profit. So here's a summary, right? And this is like the main idea, that there are two things that cause the difference between the profit under variable costing and absorption costing. Firstly is opening inventory. So the absorption costing effect is that opening inventory, fixed overheads are released into cost of goods sold in the current year. Because remember, opening inventory under absorption costing, they are fixed manufacturing overheads that are sitting in opening inventory. And when they are sold this year, they're going to be released under cost of goods sold. And because our expense is higher because of those fixed manufacturing overheads under opening inventory, then it's going to decrease our absorption costing profit. Closing inventory, on the other hand, fixed overheads are kept in inventory and they are deferred from being expensed until next year, right, when those goods will be sold. So if we're deferring an expense, the profit will increase because with deferring an expense, with delaying an expense, and by delaying an expense, it's causing your profit to increase. So this is the main idea behind this reconciliation formula. To say opening inventory decreases absorption profit, closing inventory increases absorption profit. So exam strategy, when you ask to reconcile profits, start with variable costing profit, then subtract fixed overheads in opening inventory, then add fixed overheads in closing inventory, and you're going to get your absorption costing profit, right? So this is exam strategy. So here's some of the common mistakes that I've seen. Most of the time, students, when comparing the two profit figures and trying to reconcile, they compare the total inventory instead of fixed overheads portion. So you'll see a student here, instead of only using the fixed overheads portion to reconcile, they instead going to use the full product cost, which is wrong, right? So the difference is not caused by the full product cost, however, is caused by the fixed manufacturing overheads portion, the absorption, the absorbed portion of the fixed manufacturing cost on each unit, right? So the common mistake I see is student using the total inventory product cost instead of the fixed overhead portion. Number two is forgetting that only absorption costing inventory includes fixed overheads. Thirdly, adding opening inventory fixed overheads instead of subtracting them. So most students will get this formula wrong and add opening inventory fixed manufacturing overheads instead of subtracting them. So really important to memorize this formula. And lastly, subtracting closing inventory fixed overheads instead of adding it. So just to summarize this lesson, today we learned that profit differs because absorption costing includes fixed manufacturing overheads in inventory. Opening inventory releases fixed overheads into cost of goods sold under absorption costing. Closing inventory keeps fixed overheads out of cost of goods sold under absorption costing. Therefore, opening inventory reduces absorption costing because of this increased cost of goods sold. Closing inventory increases absorption costing because of this delay of fixed manufacturing overheads being expensed under absorption costing. And the reconciliation depends on the fixed overhead portion on opening and closing inventory. So to transition to lesson number 5, we're going to practice using a full topic exam style question just to consolidate most of the principles that we spoke about in this module. Thank you for watching. If you need further personalized assistance from us, you can use the contact details in the description or the link in the description to request personalized support, and we'll be happy to assist you. One of our facilitators will be happy to assist. Thank you.